Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Thanks for being with us. Today we're talking about retail and retail real estate. Please welcome my next guest, Mitch Roschelle. He's a partner and National Real Estate Advisory Leader with PwC. Mitch, thanks for joining us today.
Thanks, Michael. Wish I could be in sunny Atlanta, but I'm in rainy New York.
That's all right. It's good to have you here on Skype. And Mitch, I'd like to ask you a little bit about malls. You know, we see that there's a lot of dead malls, but then we see a lot of malls that just seem to be doing crazy well, that are just packed and the rents are extremely high. Are people still going to malls? I mean, I know my daughter wants to go. I don't like going to malls personally. My daughter loves it. Are people still going to malls?
Well, let's not talk about the Roschelle family, because even including our dog, with the exception of my wife, we're all boys. So the malls are only important when the newest sneaker comes out, and that's when my kids get interested. But what's interesting is the ICSC has really interesting data. So if you look at mall shopping behavior, in particular visits to malls, what we're seeing is we've gotten sort of back up to what I'll call pre-recession levels in terms of foot traffic in malls, okay? But what's interesting, and I think this is where the internet, and appropriately I'm doing this by Skype, but this is where e-shopping has sort of taken over. The amount of time that people spend in malls is on the downswing, right? So I think shoppers are going, but they're more efficient when they're there. And I think what's happening to the retail landscape is it's changing quite a bit, where part of the shopping experience is the showroom effect, and some of the sales may be rung up online and not necessarily in the mall box itself.
I see. And might they be a little more frugal after going through a recession? It seems like, at least some people I talk to, not my wife and daughter, but mind you, but some people are a little more frugal when it comes to shopping. What do you think there? Is that affecting the mall traffic and the amount of money they're spending?
I think if you look at retail sales in the box, I think that they're clearly trailing behind, and from a growth trajectory perspective, the retail sales of online. So it's hard to say on a per capita basis whether or not Americans are more frugal. I think where they're shopping has certainly changed. But if you look at the retail sales numbers came out this week, they're slow, and they're very tied to consumer sentiment, and they're very tied to the worries that still remain about some of the uncertainty geopolitically, with our own economy and the like. So I think you're finding that by and large, shoppers are a little more cautious and, in fact, a little bit more frugal.
Okay. And if you're listening to this on one of our radio stations around the country or on iTunes, if you go to our show website, we're going to have some graphs that are very interesting on what we're talking about today. Of course, if you're watching the video, you're seeing them. And Mitch, where are people spending when they go to the malls? You know, where are they spending their money? Is this on food, entertainment, clothes? What are they buying?
You know, the mall itself, so if you take the retail segment and you break it down between malls, power centers, and strip centers, if we focus on mall for a second, the mall has become an entertainment complex, and it's not just exclusively a shopping experience. So if you take a look at total mall sales, while they're recovering, they're not nearly recovering the way entertainment mall sales are. So the malls function in our economy, the malls function in our sort of broader American lifestyle is really one of entertainment. So I think that the outperforming malls are the ones that provide an entertainment experience. And that could be movies, that could be food, that could be just socializing. But the ones that have sort of that entertainment feel are the ones that are going to do well from a revenue perspective.
Okay, and it's a little bit of the haves and have-nots, right? Like we talked about in the intro, a lot of malls are doing extremely well, and some just are dying and need to be torn down and be other uses, right?
Yeah, one of your frequent guests and a colleague from Reese always says that the mall population is a little overbuilt, but more importantly, under-demolished. Right. So there's really haves and have-nots. There's what I'll call obsolete malls, and the obsolete malls are the ones that, and we have a chart on it, so unfortunately those listening won't see it, so So Michael said, go to the website and see the slides. But where you have 4 more years of vacancy over 30%, that cohort or population of malls is growing. Okay, and the vacancy rate in those centers is growing. The viable malls, which are the ones that have a much better occupancy level, those are sustaining themselves. And in fact, in that population of malls, the availability rate or the occupancy rate is improving. So what you'll find is that it's haves and have-nots. That could be geography. The thing that people often forget about with real estate is the 3 L's: location, location, location. So some of them were built in a path of growth that's no longer the path of growth, or some of them were built in a market that just isn't there yet, or the demographics and economics of the market aren't there. So I think we have sort of haves and have-nots, and the haves are doing well, and sadly the have-nots are not.
Yeah, well, that's a good point. And we had Sim Dowdy on the show last week, who's an industrial broker who sold a large mall recently that has been redeveloped, and it's going to have some multifamily, but mostly industrial. And I think one of the things that was helpful there is making sure the people who lived in that market and the political leaders of that market understood that this is not going to be a mall, guys. If you're going to try to make this a mall, it's going to sit here and be a blight on your area for a long time.
Well, what's interesting is the repurposing of malls. The first generation of repurposing of malls was to take a power center that had a big box where that retailer was gone forever. They filed bankruptcy, they liquidated, and turning it into laser tag centers. Because you had the parking and it was in the right neighborhood and there was enough vehicle traffic and the ingress and egress was good. But what's happening now is they're being repositioned from a distribution perspective, and industrial uses are highly logical if the ingress and egress is good for that mall. Because don't forget, what's interesting, in more the power center than the mall, but if the property is built where people live and people are opting to shop online versus shop in a box, what people are going to do is want those goods quickly. So there's no reason why you couldn't use the former big box as a distribution facility if it's got the right bays for online retail.
Yeah, that's a good point. And if you're a political leader in the area with a dead mall, these aren't smokestacks and really tough industrial uses. These are light industrial that can bring in a lot of employment as well. And then you talked about the malls that are really doing well. So there's still a lot of tenants that are really looking to get in some of these malls that are doing really well, right?
And some of the malls are doing well. Tenants just can't get into them.
Yeah.
And some of the tenants that are in there are expanding. Or when a location opens up, that could be a B location in an A mall. Not to get too alphabet soup with you here, you'll find that tenants just move around the mall because of where the foot traffic really is. So what that's creating is the high occupancy level and the high rent growth in the A malls are creating some opportunities for tenants to move into the more viable B and C malls. And those are not necessarily B and C malls from a performance perspective. It's maybe just they're not located as well. So we've got movement inside the mall with A spaces and B spaces and C spaces, and then actually the secondary malls that are in markets that are doing okay, and the tenants are saying, well, if I can't get that spot in the premier mall, I'm going to go to the secondary one. So all of this, I think, is good for the retail asset class. Yeah,
well, good point. We're going to have to take a short break here. When we get back, we'll have more from Mitch Roschelle with PwC. Stay with us. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you in part by your friends at Bull Realty. When your business requires proven performance, visit bullrealty.com or call 800-408-BULL. Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show where we always have fun. And today we're talking about retail and retail real estate. And we have Mitch Roschelle, partner with National Real Estate Advisory Leader with PwC. And Mitch, retail has been a little slow to recover when you consider, the other sectors, hasn't it?
Yeah, what's interesting is we have a tool we refer to as the Real Estate Barometer. And for those of you following along with pictures, this is a really colorful graph. But if we look at the four wedges of the cycle from recession, recovery, expansion, and contraction. And if you compare retail to apartments, which were the quickest to recover, office, which came second, and then industrial, that in some respects shot past both, retail's still lagging behind. But historically, if you've looked at retail and its booms and busts, you found that local capital that gets aggregated to buy a piece of real estate in the last 50 years has went out and bought retail. So the chasing of the real estate investment dream has found capital landing in retail getting overbuilt, and taking a long time to digest that oversupply. So that recovery has been slow from a cyclical perspective, but I think there's more tailwinds than there are headwinds for the asset class.
And that slow growth, do you think that's healthy for the market?
I personally think, and I know it's a bit of an outrageous view in the eyes of some, but I think if you look at real estate more broadly and holistically, the slow recovery of the U.S. economy has prevented history from repeating itself, which is us throwing capital at and overbuilding the real estate asset class. So since retail was the last to recover, it was the last to get new capital dollars too. So I think that it hasn't been overbuilt. It's given us more opportunity and time to digest some of that oversupply, and as we spoke about in the previous segment, repurpose some of that oversupply. So I think it's been good. And I think if you look at cap rates, there's a correlation between that slow recovery and the very slow, precipitous sort of compression in retail cap rates.
Yeah, I mean, you'd rather have a steady growth than boom and bust, right? And let's talk about cap rates. So, what do you see for cap rates for some of these different types of retail properties?
So if you look at the post-recessionary period, cap rates in retail fell largely because cap rates in real estate was falling and interest rates were falling. And real estate was becoming, again, a viable alternative asset class, so capital found its way across all of the real estate food groups. And then as retail became the place where investors started to look when they couldn't find yields on apartment deals. And if you go back 2 years ago, the allocation of wealth and capital to the real estate asset class was all a big yield chase. So when you couldn't get the yield on apartments and you couldn't get the yield on CBD office, and you certainly couldn't get it in industrial, because industrial became the favorite child for a while and still is, I think, retail became the happy recipient of capital flows coming back into real estate, which caused cap rate compression. The value creation, though, was largely as a result of cap rate compression and not NOI growth and not rent growth. So I think we're actually in a healthy period right now where the survey we do 4 times a year, the PwC Real Estate Investor Survey, has seen in the last 4 quarters a flattening of cap rates, which means no more compression, so that the value creation that we're actually seeing in the marketplace is more about cash flow growth than it is cap rate compression. And the cap rates for regional malls are 6.58, power centers 6.65, and strip centers just around 7 at 7.09. So I think that on a risk-adjusted basis, that's a fairly healthy return considering the risk in the asset class. But the fact that that cap rate compression stabilized is actually really a good thing for the investors that want to play in the space.
So you think that you're seeing cap rates that have been pretty stable then over the last several quarters?
Yeah, cap rate compression, just as a market observer and somebody who advises clients in acquisitions and dispositions, cap rate compression often scares me because it smells like bubble, right? Because yields are going down for no apparent reason. The economy just isn't growing fast enough to support it. Job growth isn't strong enough to support it. And it's just supply and demand of capital. I think the supply and demand of capital is actually healthy. But I think the fact of the matter is that investors just want to keep the price where it is and are pushing back on yields going too low, which is good for everybody.
Yeah.
The sellers may not love it, but I think in the long run it's going to be good for the asset class.
Yeah, and it's a good point. And if you have rental rates increasing and you have occupancy increasing across the board, you're still getting improvements in value, without really affecting cap rates. Well, Mitch, thanks for joining us today. We sure appreciate you talking to us today and being with us on Skype.
Absolutely, Michael. And just so everyone remembers, I was actually your first Skype guest, so I'm thrilled to be back.
All right, Mitch, thank you. And stay with us. We're going to take a short break. When we get back, we'll talk about some trends and some strategies for landlords, and we'll also talk about some success strategies for tenants. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you by Florida International University and Bull Realty Commercial Brokerage, a great place to do business. For more information on these companies or to access additional podcasts, videos, or blogs, visit commercialrealestateshow.com.